It is a real treat to get to hear from Peter Grandich, who is back with us. He made the incredible call to predict the big run up in uranium in 2021. He took profits at the top, and now he got people out before this big bond and tech stock collapse that we've been seeing. And so he just makes correct contrarian trade after correct contrarian trade. And I'm really excited to hear what he has in store for us now and what his views are on the market. Welcome, Peter.
Well, thank you very much. I still put my pants on when I get a time, and we could spend a whole hour talking about all the errors in judgment I made over a 38-year career. But I do appreciate your kind opening.
Absolutely. Well, it takes time to work out all the kinks before you finally start to just see the markets for what they are. And if people actually do go back and listen to our last interview, you really kind of nailed the bubble behavior psychology that was going on back then that not a lot of people were realizing in stocks and crypto. And so, again, congrats on that call.
Well, I have to tell you, the crypto was the toughest because that generated the most hate mail, I guess is the only way to describe it. Hate email. No one puts it in a letter anymore. Uh, that really was, it was one thing at the end of the year, because basically what I said last year was between Labor Day and New Year's Day, if I was still managing money, I was speaking just as a private investor, but I would not want to own any general equities or bonds, which was unheard of to suggest to completely out of bonds. And I was talking corporate bonds, municipal bonds, treasury bonds. But what generated far more dislike was, telling people cryptocurrencies were going to implode and calling it the tulip mania of the 21st century. There, I can tell you I kept waiting for someone to knock on my door, being that angry. That was, how, I was called, let me just tell you the good names that I was called: dinosaur, relic, time has passed you by, here's a local nursing home you should report to. But those were all the things that I actually then referred people to. Those were indications that, especially the cryptocurrencies, was more of a cult than anything else. And people were not open and being minded. And of course, there was one person who was telling people to sell everything they own: stocks, bonds, businesses, homes, mortgage if you have to, and buy just one type of cryptocurrency, Bitcoin. And when you hear that type of talk, you have to bet against it. You don't bet on it.
Yeah, it's that contrarian philosophy that just seems to have really worked out recently, just fading the bubble behavior. And so you also, I mean, what's interesting is you knew and you're very well aware of how revolutionary the blockchain technology is, but you still didn't want to chase that top. And you said that maybe out of this, there could be some sort of groundbreaking asset that really emerges, like the internet.
There will be, just in that you're right. I've said that repeatedly in my interviews that there will be a tremendous shakeout. Look, as you and I talk, that market has gone from a 3 trillion valuation to less than a trillion. That's $2 trillion to money heaven. And that's a pretty big loss. Probably is going to rival what happened in the internet bubble. But not all cryptocurrencies are going to disappear, and not all blockchain technology. That's clearly a technology that's being embraced and will be used. But it's going to take a while for the ashes to settle, and then out of that will come. So if the good Lord has us still here 3 to 5 years from now, we're probably going to talk about things like we saw Amazon that went down to pennies or whatever, and then became a giant. There'll be some. It's just a lot of pain that still needs to go through before we can even see something like that take hold.
Wow. So that brings us to where we are today. We have the great crypto collapse pretty much as we speak. What is your big take now? I know you just released a piece to your email subscribers about kind of where you're investing. So could you give us an update on that?
Sure. As you and I speak just before, in a few hours, the Fed will make its next announcement, and barring something unforeseen, when this airs, we pretty much should be where we're at now, a couple percentage points either way or something. I think the first thing that's important is that for people such as myself, that 38 years ago, that market is completely different than what we face today. So I don't think you can use analytical devices that you were using in the 80s to look at the market of 2022. I think these are important things. I think everybody should understand this, whether they're 22 years old or 82 years old or somewhere in between. Back then, 90% of the volume was the public. That doesn't exist anymore. In fact, almost 60% of all funds now are in passive management, which means they're in index funds, they're in different things, but they're not actively being managed. They're trying to track something and whatever the case may be. Well, that worked greatly when the market was going up and the monetary heroin that the Fed was pumping in was pushing everything up. Problem now is if we are in this serious issues of a wide range from energy to inflation to all these political and social issues, that is not going to, when people that have that want to exit, there's not going to be a management active that's going to say, hey, wait a minute, I think you're selling the wrong group or whatever. They're just going to liquidate and selling will beget selling. We haven't seen that yet. I believe we have to have that before there's this eventual general bottom in the equity market. So that's important. That's why I still don't believe, even though, like you said, I think we've just reached a short-term crest and we're probably going to see another bear market rally. But I don't think we've gotten to that true bottom yet where I personally would want to go back into general equities. And we're certainly not there in bonds. You know, if I can also make this point, as you and I speak, we just had 2 days where the 2-year and 10-year treasury went up 50 basis points. Listen, they didn't move that much for years, let alone in 2 days. Now, I believe that was also because there's other issues going on in the credit market that we're going to learn of in the coming weeks and months. And so no matter what the Fed does today, there's still a lot of issues before us. And I still think rates have to go higher. So I don't think it's quite yet a time to look at bonds. So what does that leave besides cash? And remember, when you and I spoke, especially in 2021, when I was saying make cash your single largest position, there was a big theme around called cash is trash. You remember that? And there's a very famous money manager that was highlighting that in Gulf. Well, I would bet you now, and I don't mean to make fun of them, but those people that were calling it trash probably would like to have that cash back now versus whatever they went into. Chances are they're losing on that. But having said all that, you're only as good as your last call. And hey, what have you done for me lately? That's how this world has become in the financial world. For myself is I use a investment sentiment graph that a gentleman created that has become a holy grail for me. And gold and silver are still at despondency and depression. Now, part of that is because some of those people also own junior resource stocks, which have been horrible. I put out my own personal portfolio today. I showed what I owned and what percentage, what did I buy it at? And I'm down. So I didn't escape it. I don't walk on water. Only Jesus did. But the gold and silver market have literally still no real interest. And not only does Wall Street always treat it like kryptonite, even people that might have 5 or 10 years ago. Now, some of those people got caught up in cryptocurrencies. They bought into this new argument that crypto was replacing gold. It didn't. Okay. But if you buy things like you talked about being a contrarian and when no one wants them and all, I would say that if you and I went to any financial institution in any part of the United States and looked at any 100 accounts, we wouldn't find 1 or 2% of those accounts have purchased gold or silver, or the professional advisor managing those accounts or advising those accounts. So that's a market that's clearly underowned and has managed, believe it or not, especially gold, to hold its own during this extremely sharp sell-off. But because we also own mining shares and juniors, and they're down 10, 20, 50, 60% from somewhere some of us bought them, we just want gold and silver to go up so the pain of owning these juniors would dissipate or go away. But looking at gold and silver on its own, I would certainly risk buying it today at today's prices before I would even step in now into stocks or bonds or some cryptocurrency.
Yeah, like you said in our last call, what really matters is how much you don't lose. And so you did pivot into the miners, which were low downside. And that's been a better store of value through all this chaos by far than obviously owning even the NASDAQ right now.
Yeah, you make a very good point, and that's important. I live on the thesis it's not how much you make, but how much you don't lose is going to separate you from the winners or losers. So if everybody else lost 60 and you lost 10, it's bad that you lost it, but you can still play the game a lot better going forward than the people that lost 60%. And that's what gold particularly was to me. And of course, and I may be stealing your next question, but of course, there's one other market that I like very much, and that's the uranium market.
Absolutely. Yeah. So yeah, exactly. You did time that one pretty well as well. So just thinking about kind of the setup here, what causes the money that's, floating out there to move into these sectors in this crazy environment?
Well, I think that's a challenge. That's one of the difficulties that those of us, or those few of us, it seems, still want to own things like junior resource stocks or mining stocks in general. It is a real challenge now to be a junior resource company. I mean, years ago, and let's take that understanding that a lot of the junior resource companies are at least managed and run out of Canada, even though they may own assets all around the world. And it was fairly easy for that company back then to promote its wares all around the world into the US securities market and all. Now it's all but impossible. The complications, first of all, almost all brokers, even if people are using still full service brokers in the US, they can't even take an unsolicited order on a stock that trades in Canada or the over the counter market here and all. Second, competition. Years ago, when people wanted to be speculative in gold, they bought juniors. Then these ETFs came along, and if you're not in those exchange traded funds, most institutions, managers, and all won't even consider you. And then, of course, the compliance standpoint, brokers here can't even take an unsolicited order on a junior. So there's real challenges now compared to when I worked in that business for that exposure, plus the competition. Until recently, cryptocurrencies and marijuana stocks and things of that nature were taking away from what people used to look at as the junior market. Will that reverse and go back to what it used to be? No, I think that's forever gone. But it won't take much to come from other areas into it to really drive them higher, because they have little or no interest at this time.
That makes sense. I know this is a completely unique market. Like you said, the bond market has never behaved this badly in history. But just going back to the last time we had really bad stagflation was the 1970s. We really had a lost decade in stocks almost, from like early 70s to the beginning of the 80s. Just stocks did nothing, but commodities just massively just skyrocketed. There were a lot of dynamics back then. Do you see kind of a long-term kind of trend shift into hard assets and resources away from stocks similar to that, or is this market just different?
Well, I only speak as a U.S. investor, a private investor, and still have a pulse on somewhat what's happening in U.S. financial institutions. Gold has always been and always will be, unless the good Lord comes again, treated as kryptonite by financial advisors and institutions. To expect the typical financial advisor or institution in the US to turn around to their clients and say, hey, I really think you need to get into gold or some gold stocks, is just not going to happen, because it flies in the face of what they make their living off of, which is selling the wares of financial assets. So I don't ever think there's going to be a worldwide opinion that you need to own gold. But what's been real interesting, and which really underpinned my reason to own it, is central banks continue to buy it aggressively. And again, it goes back to an argument which I think now has been advanced because of what happened in the Ukraine-Russian war, and let me explain. I believe central banks recognize that sooner or later, fiat currency is going to implode. We're already seeing a lot of that taking place. I really do. What we did by weaponizing sanctions, and because of what happened in Ukraine and Russia and all, certainly accelerated certain countries in the world to think, hey, do I really want to be with the US dollar as the reserve currency? Granted, it's going up now because our rates are leading, up and all, but do I want to risk having a lot of US dollars or the US country able to tell me and dictate and tell me what I can and can't do with my own money and stuff and all. I think what happened with Russia, albeit a terrible thing that they did, accelerated the timeline to see the end of the US dollar as a reserve currency. I think we're going to see more and more countries trading around it and using commodities in lieu of anything else, or hard assets in lieu of paper money. So I think that's the biggest news that isn't news yet in most people's minds, but will be in the coming months as we go forward and so forth, and will be a net plus for the commodity market. The other thing I think that's as important for the commodities, and whatever commodities may be, is until the pandemic, most Americans had no idea that we weren't making a lot of stuff that we need. That so much through this globalization movement that Wall Street touted and said was going to be a great nirvana took place. And suddenly when the pandemic came, we realized drugs we needed, supplies we needed, all the things, a lot of things that we needed were not here in the United States and were being made or key parts of it by countries that aren't exactly the best of friends of the United States, especially now. So the commodity argument is a lot different than it was in the 70s and 80s. Okay, it's shaped up. There's been a lot of neglect to spend serious dollars. Here we have, as you and I speak, gas is $5 and all, and and Biden say, oh, let's release more oil. It has a little bit to do with oil, but one of the reasons gas and diesel is up at where it's at is we did away with refinery capacity. And who is in their right mind when Democrats are touting all about green and everything? The oil people are bad, and now we first wanted to encourage them to make more, and then as soon as they stop making money, we're going to tax you because you're bad people. Why would I, as an oil company, want to think about building a new refinery now, especially when you're telling me 10 or 20 years from now, all the cars are going to be electrical? So people need to know this gas price problem is not going away because we don't have the refinery capacity, okay, that we once had and all. Also, the oil supply is pretty well tapped. I mean, yeah, we're going to go over to Saudi Arabia now. It won't show it on TV, but trust me, he'll be on his knees when he talks to the prince, because he just called them all sorts of names when he was running for president.
All right.
Even if they decide to kick in the 1 million or 2 million, maybe more spare capacity they have, that'll actually be a net negative because people are going to go, hold it, that's it. That's all we got. And so there are dramatic differences to look at commodities than it was now. Did we get too far too fast? Did the nickel prices go up too far? Did copper and all? Yeah. But now this corrective thing that we're seeing here, I believe, is offering investors, people who have, if there's still anybody out there that invests for years, not minutes, hours and days, I think this is going to offer an opportunity to be involved in commodities. I certainly, as I told you, uranium is my favorite, but even copper now, especially the closer it is to 4 or dips under 4, because there's structural issues that are just not going to allow ample new supply to come anytime soon. And yet the world is clearly on a path where it's going to need more and more of it.
Yeah, that is such a good point. The whole globalization kind of structure that was in place before has been disrupted, and it probably will continue going that way with China and Russia kind of moving. There's a lot of geopolitics happening, which is changing kind of the world order. And so that is one impact. But also one thing you called correctly the last time we talked was that the Fed would not be able to continue to stimulate the market higher. A lot of people were saying, well, if the Fed is printing money, then we have to own stocks. And so you predicted that they would not be able to continue to do that. And now they are trapped. And so it seems like the Federal Reserve's decisions matter so much to financial markets, probably the most important decider right now. So I guess, what is your take on what they're going to be able to do? Because in one scenario, they just keep hiking interest rates and everything crashes, including commodities. And in another scenario, they ease up. So how does that play into your commodity thesis?
So let me first give you my pet peeve on that. And I share this with a lot of people. And I guess people that follow me are going to say, oh my God, here's Grandich again bringing it up. But I don't find it I find it a lot more than coincidence that monetary heroin, and I'm not probably the first to call it that, and it's been called different names like that, spigot was turned off. At the same time, a bunch of Federal Reserve people who were trading their own accounts and we didn't even know it and made a lot of money were caught and had to sell and get out, which happens to be the top of the market right now. I don't think that's a coincidence. Okay. And it aggravates me that, and those guys, and there might have been a gal or two, I don't know, they hope their names are never brought up again. But you're right. So long as the Federal Reserve was doing that, imagine if you were them and you knew that the guys you work with are all going to come in and vote, yeah, let's keep this party going. I would have been long equities too. But I think that part is gone. Now, there's one thing I think that we're not hearing in most financial journalism. I call CNBC tout TV. I think it's a horrible place. It's just it's a place where the don't worry, be happy crowd that makes up much of the financial service industry calls home and gets to tout their wares. But Bloomberg TV has an excellent show from 6 to 9 o'clock in the morning, just really brilliant financial journalism. And they have hammered home a point that I'm not hearing a lot of people talk about. Yes, the Federal Reserve can impact demand. And we hear the word demand destruction. Yeah, Volcker did it. He raised interest rates so high that, basically demand had to stop because interest rates became so high. But the difference this time is we have a supply issue. The supply disruption, because when everybody did lockdown, no one decided to go, wait a minute, if we lock down and we stop everything being made, we just can't turn it on and have everything running tomorrow. And now almost in every facet you speak to people in every type of industry, not only were they facing a labor issue, but now far worse than that is a supply issue, parts, things that they need, and one feeds into the other. Federal Reserve can't influence that. Supply is supply. And the classic inflation is when there's too many dollars, which we created how many trillion in just the last few years, chasing too few goods. And that's something the Federal Reserve really has no impact with. Plus, this is not a problem just in the United States. Inflation isn't just at our borders. It's worldwide. So until all of the major Western central banks get into that mode, Japan clearly isn't, China isn't, Europe is kicking and screaming, but they're not yet getting into a significant tightening mode. Yeah, the Federal Reserve can tighten all at once, and since it's the reserve dollar, have an impact, but we're going to need to see it worldwide. And it's still not going to impact the supply crisis that's going on. So that's why I think as much as commodities are likely to pull back because things will slow down, I don't think they're going to collapse as most people would expect them to, because there's been such an utilization to get more of them, and the world needs a lot more of it than it needed back in the 70s and 80s. The one commodity that's just as good in my book and probably more safer to play if I had to risk it is the uranium market. That's a market that really only can go down for two reasons. One, the world goes into a worldwide deep recession and depression, and they have to forestall building all the needed future nuclear reactors, because that's the only way you're going to solve the energy problem. Nuclear has to be a major player in it, or there's a terrible nuclear accident again. And politically, people go back to hating nuclear because it's politically correct to do so. Outside of that, the uranium price, and as you said at the onset where I'm at, is not going to fly up like it initially did, but now it's just going to work its way higher. And it's very few ample ways of playing it. And that's why I think, I don't want to say toss a dart, because there's a lot of stuff that won't get developed. And even if they're sincere, it may take 10 or 15 years to their initial deposit could be somehow turned into a mine and gets all the approvals and all, and miss this great move. But I think the uranium price is the one commodity that should only work its way higher and be maybe twice its current price in the next 12 to 24 months. And for me, I don't know if you don't mind me mentioning, there's so few ways of playing it. The Sprott way of owning, having interest in the physical price is a great way. But I think Cameco has to be in everybody's portfolio. This is a super run company that literally speculated on the market getting to where it's come now and can profit handsomely from it without too much concern that it's some shot in the dark. And if they drill and nothing comes up, you lose your principal. So I would make Cameco a key factor in that. And copper, I think, is one of the metals that I think has to be just under that ownership in uranium and gold. And if I may, my largest single holding, and again, people need to do their own due diligence and carefully, but it's the once in a lifetime play. It's certainly the largest holding I've ever had, Arizona Metals. Yeah. Where you look for metals now is critical. When I was back in the business as a money manager in the 80s and 90s, you could spin the globe, just not even look, point your finger and say, okay, let's go there. Now, there's very few places you want to go. I have restricted my own personal investments to just North America, Canada, and US. And even there, I probably would not want to look at some things in California, but I don't mind owning things in Arizona and Nevada for mining and so forth and so on. So I think it's going to be critical to understand that it's not easy anymore to just pick anywhere in the world and go look for a commodity, find it, develop it, and sell it. And that's another underpinning to commodities in general, and why, again, like I said, owning commodities here going forward is still, to me, a better bet than owning general equities or bonds.
Absolutely. I'm so glad you gave us your thought on the uranium market, because so we are seeing this reawakening. It is politically correct right now to be all in on uranium. The US is trying to buy up domestic uranium. And so I guess that is kind of fuel to the fire with the uranium price, which you're saying has to be worked up, because right now it's not sustainable where it is in order to fuel the future growth in nuclear energy.
Right? How about this? America uses 50 million pounds a year to fuel its nuclear reactors. Do you know how much we basically produce here?
Yeah, that's right.
That's why a company like Kraken Energy, and there's others that are looking to develop either old mines and or new areas, are going to be looked at by investors, because America is going to have to go back to as it once was, depending on some of its own uranium finds, in order to make sure its nuclear plants can run, because the blackouts and brownouts are going to be widespread, because the infrastructure of our electrical system in the US, I like to joke, is so bad that some of it was installed by Thomas Edison himself. Yeah, right. But the bottom line also is, look at the increases. People in Illinois are facing a 400% increase in their energy bill now. And that's going to be other states, because the much higher cost it costs these utility companies to provide it. So you said it correctly. What was once a political non-starter, it was politically incorrect to talk nuclear. In fact, there was only a couple of years ago where there were congressmen and all saying there'll never be a new nuclear plant built in the United States. Now they're the guys leading the charges. How fast can we get one up so I don't have to hear my constituents complaining about energy shortages? So there's been a 180-degree flip for the better for the uranium industry politically here in the United States.
Exactly. And so we just talked about your commodities thesis. Well, uranium is primed to take advantage of that, but also just so many other bullish fundamentals behind it, regardless of the overall broad commodity potential bull market we're about to see. And so just do you want to get your thought on Arizona Metals? So what makes that mine special to you, and why is that?
Well, first of all, I must fully disclose, it's my single largest holding I've ever had. Wow. I have more in it than I ever thought I would have as a young man of your age. So, it is a very large bet, and you can get caught up in it. And I have heavy biases and prejudice. There's another bias I have. The largest single shareholder is a man named Michael Gentile, who to me is the missing link that I look for all the years when I worked in the natural resource industry, but can never find. He's a phenomenal gentleman, devout Catholic Christian for me, which is even more important than his intellect, and puts his own money where his mouth is. But Arizona Metals is it's almost too good to be true, and you always get a little nervous when you get to that level. But it had an historical resource that now has been significantly drilled enough to where conceptually analysts, Michael Gentili and myself, can see that it's much, much larger. It looks 3 to 4 times larger than the historical resource already, but is now embarking on drilling 2 targets near this deposit, which look equally, if not better on paper than this deposit known as the K deposit did. So I'm not worried about, hey, they're drilling some, grassroots thing, and if they don't hit, the stock is going to zero. I do believe the current share price, as you and I speak, more than supports what already we have, and then some. I think even if it stopped today, I think this is worth twice the price what it's currently selling for. But if we're so blessed that what looks like to be similar or even bigger deposits nearby appear to be shown to be the case, then this stock could offer multiple returns in its current price with limited downside risk in an area of the world where I'm not too worried about political terrorism or anything else is that we face in other areas of the world, run by a fantastic management that has raised all the money, has 65 million in the bank. It is not going to need to go to the market to see if we're correct about what I just expressed. And so therefore, those are the type of things that I think people, if they're going to look at areas, it's a copper, gold, zinc play. Those are all metals that you and I, we didn't discuss zinc, but all metals that should be at least around the current price, if not higher. So it has all the things that one will want to have going for it. And it's not known. The company has not spent, in fact, it's hard to imagine a company with almost a $500 million market cap doesn't even have an investor relations officer. I know that sounds crazy because in the junior market, that's where a lot of money is spent. But that's because they've done such a phenomenal job, and they're already well on to becoming a major player. But even that's set to change now because I believe they realize that their story is coming so big and it needs to be told in a bigger and better fashion. So it's the reason I feel in the real latter stage of my career, if I'm going to throw the dice, this is the one I'm going to throw the dice on.
Wow, that is so good to know. I did speak to someone who's an expert at investing in mining stocks, and he said, don't bet on pre-discovery plays. Go for the ones that already have the good news baked in that's being discounted. And that's what this seems to be doing, right? They found the big pile, and the bullish fundamentals from that are probably just going to continue to.
Yeah. So. The best line I like to use, I guess the one that helps me go to sleep and not worry, is the best is yet to come. That's what everything looks like at this point. Doesn't mean it's going to happen, right, but everything has the makings for it.
That's amazing. Well, we'll definitely look into that. Obviously not financial advice, but you mentioned Cameco, which will cash flow in any uranium market. So it's pretty much a stalwart, probably always going to do well, but it will do even better if uranium rises, and we'll look at that one. Thank you so much for your valuable time. Where can people go to learn more and stay on top of your updates?
Well, I shared just as a private investor. I don't really do social media anymore. I mean, we do have a YouTube channel, but I use that to either put up interviews like yours, so followers of mine and friends and clients can follow it. I have a blog, but it's best to go to my website, petergrandich.com. They can sign up for the blog by just putting in their email, and every time I write something on the blog, within a couple hours, it's automatically emailed out.
This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.